When Japan's economy crashed in 1990, Hawaii went down with it. Real estate in Hawaii plummeted. Layoffs were everywhere. I knew people, firefighters buying land over there when this happened. I didn't even see it. And this took the entire state 10 years to recover. But here's the part that nobody tells you. The patient buyers picked up the same homes for pennies on the dollar. And that's what every recession does. It transfers assets from the panicked to the prepared. Now here's how to be on the right side of that transfer this time.
In the early 90s, a specific group of people bought properties in Hawaii for prices that should not have been possible. Not investment funds with billions behind them. Ordinary buyers who understood one thing that most people did not. When a purchasing power ends and forced sellers have no choice, the discounts get brutal and the window closes fast. Barry Sternlicht launched Starwood Capital with $17 million and bought the entire Westin Hotels portfolio in Hawaii for $537 million. That was 60 cents on the dollar for assets valued at $1.35 billion just 6 years before. Individual buyers picked up Honolulu condos in 1994 that doubled in value within 7 years. No leverage, no fund, no luck. They saw the pattern and moved before the headlines. That pattern is running again, but not in Hawaii, in Japan. And the entry price is lower than most Americans realize. By the end of this video, you will know exactly what created that window, why most people will miss it, just like they missed Hawaii in 1994, and what this pattern means for any distressed market that opens up in Japan, the United States, or anywhere else. Here is what created the Hawaii buying opportunity and why the current Japan setup rhymes with it directly. On September 22nd, 1985, the 5 largest economies, the United States, Japan, West Germany, France, and the United Kingdom, signed an agreement called the Plaza Accord at the Plaza Hotel in New York City. The agreement was simple. The 5 governments would coordinate to deliberately push the US dollar lower against the Japanese yen. In plain terms, they agreed to make the dollar worth less so that American exports would be more competitive globally. The side effect nobody fully accounted for was what it would do to Japanese purchasing power overseas. Within 2 years, the yen went from 250 to the dollar to 120. Japanese purchasing power overseas effectively doubled. Capital flooded into Hawaii. Between 1985 and 1995, $12 billion of Japanese investment entered Hawaii, compared to $850 million in the prior decade. Aoki Corporation paid $1.35 billion for the Westin Hotels portfolio. Mitsubishi Estate paid $846 million for 51% of Rockefeller Group. The median home price in Honolulu went from $188,900 in 1985 to $498,511 in 1990, a gain of 164% in 5 years. Then the Bank of Japan raised rates 5 times in 8 months. The Nikkei, Japan's main stock market index, dropped 50% by October of 1990 and 82% by 2003. The asset values Japanese corporations had used as collateral collapsed at home. The forced selling began. Aoki sold the Westin portfolio for $537 million, an $813 million loss. Mitsubishi walked away from Rockefeller Center entirely. The people who bought at those forced sale prices held through the recovery. Mitsubishi Estate paid $846 million for 51% of Rockefeller Group. The yen has depreciated roughly 40 to 45% against the US dollar since 2021, moving from approximately 110 yen to the dollar to over 160 today. That means Japanese property is effectively discounted by 40 to 45% for any American buyer compared to 5 years ago, before a single negotiation begins. On top of that currency discount, Japan has approximately 9 million vacant homes, known as akiya, a Japanese word meaning empty house. 1 in 7 houses in the country sits vacant. The number has been climbing for 30 years, driven by an aging population, rural depopulation, and inheritance customs that leave properties trapped in legal limbo when owners die without heirs willing to take them on. As of April 2026, one database of IKEA listings contains more than 28,800 properties priced under 1 million yen, approximately 6,600 US dollars at current exchange rates. More than 58,000 listings are priced under 5 million yen, approximately $33,000.
And hey, real quick, I gotta jump in. If you want even more information on how to prepare for this, links down below to the real estate crash bundle. It teaches you everything from real estate cycles, real estate bear markets, what to buy, when to sell, everything. You're gonna be blown away. Links down below, one crazy low price, and afterwards you're gonna be like, Ninja, I want more. I want more. I want to crush it. All right, now that I pumped you up, let's go back to the really somber informational video.
These are not raw land or uninhabitable structures. Many are structurally sound homes with established utilities priced low because supply significantly exceeds local demand. Foreigners can buy Akio with the same legal rights as Japanese citizens. There is no minimum purchase price, no government approval process for foreign buyers, and no restriction on the type of property foreigners can own. Government subsidies in 2026 can cover 30 to 80% of renovation costs, with combined national and local grants potentially offsetting a significant portion of the total investment. The pattern from the Hawaii buyers is present: forced sellers, a currency-driven discount, and a government actively trying to move inventory. One distinction before the four moves: the Hawaii opportunity in the 90s had a clear bottom. When Japanese banks stopped forcing sales, the market stopped falling. Buyers knew the worst was over. Japan's Akio situation is different. The empty homes are not from a banking crisis. They are from demographics. Japan's population is aging and shrinking. Rural towns are emptying out over decades, not months. There is no single moment when the selling stops. The discount is real and it is large. But there is no guaranteed turning point like there was in 1994. For an American buyer, the currency advantage and government subsidies are the story, not a pending recovery in rural property values. Go in knowing that. The opportunity is real. The risk profile is not Hawaii. The main risks are clear. Liquidity is limited and selling an Akio can take time, which may mean accepting a lower price than expected. Resale demand is weak in depopulating areas, so holding periods may be long. Ongoing costs like maintenance, property taxes, and repairs add up. Go in with eyes open. The four moves that follow are built around that distinction. One clarification before the four moves: this is not a call to buy a house in Japan. For most people, that is not the move. The point is to see the pattern. Currency drops, forced sellers, government incentives to clear inventory. That combination creates a window. It is not unique to Japan. It rotates through markets worldwide. It has already run in the United States. The buyers who moved in Phoenix, Las Vegas, and Miami in 2010 and 2011 after the foreclosure wave followed the same playbook. Distressed sellers, no competition. Government programs to clear inventory. They did not need a passport. They needed to see the pattern and have cash ready when the window opened. Here is the opportunity cost in plain numbers. The average homeowner in a high property tax state pays more in annual property taxes than 3 round-trip flights to Tokyo. New Jersey homeowners pay $9,358 a year in property tax. A round-trip ticket from New York to Tokyo is under $1,200. 1 year of New Jersey property tax covers more than 7 round trips to the country where these discounts exist right now. The point is not to move to Japan. The point is that the same money leaving your account every year in taxes could, with a different allocation, be studying and positioning for the next distressed market here or abroad. The pattern is the asset. Geography comes second. 4 moves: specific, named, actionable, without a hedge fund. First, search the IKEA database this week before the window narrows further. English language searches for Japanese property are up 6-fold year over year. The buyers who moved in 1994 were early. The buyers searching in 2026 are still early relative to where this market will be in 5 years if demographic trends hold and the yen normalizes. The primary English language aggregator for IKEA listings is IKEA Japan at akiajapan.com. Maneki Homes aggregates municipal listings in English. Search by prefecture, price, and condition. The listings are live and updated. This is not a hypothetical. The properties exist and can be searched today. Second, understand the full cost before the listing price excites you. A property priced at 0 yen or near zero usually means the municipality cares more about occupancy than sale proceeds. Expect to spend money on renovation, cleanup, utility hookups, and ongoing taxes. A Kia can be bought for as little as 500,000 yen, approximately $3,200. But expect renovation costs of 3 to 10 million yen, $20,000 to $65,000. The entry price is the listing. The actual cost is the listing plus renovation plus transaction fees plus ongoing property tax. Run the full number before committing. Third, use the government subsidy programs before they change. The Ministry of Land, Infrastructure, Transport, and Tourism actively promotes vacant home utilization, framing 2026 as a critical year for policy pushes. Municipal governments in depopulating areas are offering renovation grants, covering 30 to 80% of eligible renovation costs to attract buyers willing to occupy and restore vacant properties. These programs are budget dependent and change annually. A buyer who moves in 2026 captures the current subsidy cycle. A buyer who waits 2 years may find the programs restructured or oversubscribed. The subsidy is a finite window inside an already finite opportunity. Fourth, use a local buyer's agent who works with foreign clients and speaks English. Many municipalities have official Akia banks, online databases of vacant houses maintained by local governments that are Japanese only and can be difficult to navigate. A buyer's agent who specializes in foreign clients handles the language barrier, negotiates with sellers and municipalities, and manages the legal registration process. The legal maximum agent fee in Japan is approximately 3% of the purchase price plus 60,000 yen plus tax. On a 5 million yen property, that is roughly $1,500. For that fee, the agent navigates a process that would otherwise require hiring a translator, a lawyer, and the property inspector independently. The 1994 Hawaii buyers who made the most did not do it alone. They used local operators who understood the market. Same principle applies here. The people who bought in Hawaii in 1994 were not reading different news than everyone else. They were reading the same data earlier and acting before the opportunity became obvious. The ones who bought in Phoenix in 2010 did the same thing domestically. The pattern does not care about the geography. Currency discount plus forced sellers plus government incentive to move inventory. That combination has produced generational returns every time it has appeared, in every country, in every decade it has run. Japan is one current example. It will not be the last. The next distressed window may open in a US metro after a local economic shock, in a Latin American market after a currency devaluation, or in a European city after a demographic shift empties out a housing stock nobody wants to maintain. The skill is recognizing the sequence before it becomes the headline. Stay close to this channel. We track the pattern before it becomes obvious. This is Economic Ninja, and we will be watching it for you.